Hey everyone, it's Rob B here with Rob D, and you are listening to the Property Podcast. This week we have a mortgage expert on, and we're going to talk about what the market has done recently, where it's going in the future, and then we get into a deep discussion about down valuations, something that's just not discussed anywhere else, but we get into some great detail there. You're going to absolutely love it.
Welcome to the Property Podcast. Thank you for joining us. In case you don't know, we run a business that buys more than £100 million worth of property every year. You can find out about that at propertyhub.net/invest. And we talk over and over about the power of when you're buying a property using a mortgage. That leverage is one of the main benefits of investing in property. But there's always so much uncertainty about which product you should be going for. And there are often some challenges that get thrown up along the way as well. So keep on listening, because the information our guest is sharing today might just rescue your next deal. First, though, into our news story this week, and the government is at it again. Yes, more legislation incoming, at least if the government gets their way, following a consultation they've just put out about energy performance certificates. So at the moment, as you'll probably know, every rental property needs to have at least an EPC grade E, and it's been rumoured for years that the requirement is going to be raised up to a C. A consultation into that has finally begun, and as part of that we can see what the government's intentions are, and it is to make every property require a C by 2030. Now, before you get too worried, there are exemptions in there. So if you've got a really, really old property or a listed building or something where the only way to achieve that would be to damage the structure of the building, there'll be exemptions. If you've got a freeholder or a tenant who's not playing ball, so you won't be able to hit the deadline, exemptions for that as well. But for some landlords, there will be work to be done. And to make matters even more confusing, at the same time as this, they're also consulting on changing the ways that EPCs are calculated. And just to make all of this a little bit more complicated, at exactly the same time, they're also consulting on changing the way that EPCs are calculated. So for now, I would say this is something to be aware of rather than something to rush and do something about. We, of course, will keep you updated here on the podcast and in our free weekly newsletter, which you can sign up for at propertyhub.net/pulse. And we'll go into more detail about what the proposals are and what we think we should be thinking about doing at this stage in our next market update. So Rob B is out in Dubai. I've been left here at home, and that's fine, I guess, not bitter at all. But while he's there, it seems like he is doing some work, because he caught up with Nick from Framework Mortgaging. We've had Nick on the show before. He's got an absolute wealth of expertise when it comes to mortgages, especially buy-to-let mortgages. He works with a lot of investors. He works with a lot of people with more niche situations like expats. So he really knows all the ins and outs. And we're so happy he's here to share his knowledge on the show. In particular, in this interview, you'll hear about down valuations. This is something that investors have had to deal with more and more over recent years. And this is something that at the very least is very worrying, especially if you think you've done yourself a good deal and then the lender's coming back and saying, no, it's worth less than that. And at worst, it can kill your deal completely. So this will be a really important listen. So over to Nick and Rob.
So Nick, great to have you again. Let's start with what everyone wants to know. What's the state of the mortgage market right now? We're early part of the year. We have just seen an interest rate cut, which I'll come to. But how has 2025 started with the mortgage market?
It started well, cautious. I think from October last year, there were various economic events which obviously sent a few shockwaves into the global markets, global elections, budget, and the reactions from that. And then we had, expensive long-term bonds, lender funding lines increasing, and most importantly, sticky inflation not really coming down to the level we would hope for. And because of those elements, buy-to-let rates stayed high. I think the problem is with buy-to-let that everyone sees the hopefulness of the base rate coming down.
Yeah.
And they're seeing we're going to have reductions this year, maybe 2 or 3 cuts. But how lenders work is they're already pricing that in.
Right.
So the rates that you see now is assuming those cuts, because essentially they're projecting their funding lines over the next kind of 5 years, the infamous SONIA swap rates. So we're not going to see rates falling off a cliff, but they're still workable for the right property and the right amount of leverage. So, in summary, it started cautiously but positive. And I'm still kind of hopeful with my projections, kind of late 4s with a good product fee for specialist buy-to-let. I think that's achievable. But as always, the property choice directs your lender choice. And that's the really critical thing that clients need the transparency to in the current climate.
Well, let's come back to that, but I want to touch on interest rates because I wouldn't say it was a shock, but certainly maybe earlier in the year than many had expected. But based on what you've already said, it seems like that's not really moved the mortgage market. Had that been priced in, or has there been a little bit of movement off the back of it?
There's been a little bit of movement, confidence. The confidence to reduce them by 25 basis points. It's not dramatic. But I think buy-to-let's quite layered. Okay, so you've got various different lenders in the market, even within the standard AST rental agreement market. So you've got the banks and you've got the specialist side. So the banks obviously have access to cheaper line of funds, and that's where you're going to see in the current market 5-year fixes, limited company, mid-4s with a fairly decent product fee.
Yeah.
Because their banks have access to cheap funds. Buy-to-let is one arm of a financial organisation, okay? So they can afford to be a little bit maybe bullish with the interest rates. The more conservative approach comes from the specialist lenders, where they are institutions solely concentrated on buy-to-let lending. So they have to watch their margins and they have to simply cover their margins. And that's where you see probably top 5 rates. A lot of clients might say it's mid-range, but those specialist buy-to-let lenders, that's where the product fees come into it. But it's still workable. But it's really clients, if you're in that market, look at the all-in rate, not just the interest rate.
Yeah, and you touched on clients' expectations and the products that people see advertised online and then the products they actually get is obviously, well, not maybe obvious to everyone listening, a mismatch. The best out there is actually for a very small group of people, and actually they have to accept different rates. How do you manage your clients' expectations with that? Because it must be difficult. You see a really sexy rate plastered somewhere. They come in and go, Nick, I want to get this. And then you're coming back in maybe with something that's 0.5% more. That obviously makes life harder, I imagine.
It does. But I tend to have a long-term relationship with my clients. So it's kind of speaking to the clients all throughout their journey. We've got a WhatsApp channel where we provide interest rate kind of updates as well. So it's just setting expectations from the start and it's educating clients. Because like I alluded to before, buy-to-let is a really layered market. And it's like you said, there's always a starting rate, which is just classic marketing, isn't it?
Yeah.
Rates from 3.99, but what they're not telling you that it's a 2-year fix, limited company with a 7% product fee.
Yeah.
It's really difficult for clients because the more clarity they have by having a really strong relationship with the broker, the less shocks they're going to have. So I'm very keen for brokers to work with clients over the long term and have a continuous ongoing conversation just so there's no shocks.
Yeah.
It's great for me if I speak to clients before they reserve, which is not always possible, but that goes back to a change in market. Probably 5, 6, 7, 10 years ago in buy-to-let, it was a less professional market and people used mortgage brokers quite understandably like they were a residential mortgage broker. Yeah. They speak to the broker when they're buying because rates were cheap and the advice was quite flat, one-dimensional. But now as the market's evolved, there's a whole huge market out there that it does get layered. So I do encourage clients who are in the buy-to-let space to speak to your buy-to-let broker like you would an accountant. It's an ongoing relationship. And the more information you have, like in the accountancy world, the more transparent it is for you, the more comfortable you are, and the better options you'll have, and the more prudent investment choices as well. Because that goes back to the lender choice, so the property choice, directing the lender choice.
It's interesting what you said, word information. Another way of describing that possibly is education. You have to educate your clients. What do you find is the number one thing that you have to educate your clients on? So when a new client comes to you, where do you feel like the biggest learning curve is for them, particularly if they're a newer investor? Maybe they've done 1 or 2 deals, or maybe they're brand new. What do you normally have to take them through?
Well, just the general advice process, like I say, it's not a complicated market, but it's very layered. Okay, so there's 2 important things that some clients don't realise when getting a buy-to-let mortgage. The advice is 2 elements. The first element is, the client, who you are, where you are, and how you saved up for your money. That's critical. Standard. That's what the whole process was, X number of years ago. But it's the property type as well. It's the second element, critical element. Not all lenders want to lend against all properties. And it's nothing negative against the property you're buying. It's just different banks want to do different things with their money.
Sure.
So it's just those 2 important elements. So, for example, if you're a limited company borrower and you want to use a building society, you're probably not going to be able to buy a city centre flat, Manchester, 20 stories on the 20th floor, because building societies, because of their business models, don't want to be exposed to those kind of assets.
Yeah.
So it's nothing negative. It doesn't necessarily impact your pricing as well. When I talk through this, some clients do get concerned that maybe it's impacting their pricing. Well, it's not. It's just picking the right lender for the right situation, just like any other lending, really.
Well, let's talk about pricing. We've talked about headline rates, but right now, as the mortgage market stands today, as we record this, What's the realistic rate that a buy-to-let investor investing through a limited company, what should they be expecting? And I appreciate, different circumstances, but just is there a rough guide for people to understand what the market's doing right now?
A standard scenario, 4.99%, late forwards essentially, with a 3% product fee is, a viable option for you.
And is that a 5-year product?
As on a 5-year basis, yeah, absolutely. As an investor, because of the volatility of the market, I would always encourage people to run their numbers at 5.5%. I always like to be conservative and start with worst case, because I think that people should stress monthly payments at the worst. I do encourage clients to take low interest rates and maybe take a bit of a fee, not necessarily the cheapest overall, but I think it's prudent to manage your cash flow, especially if you've got a smaller portfolio. You'll know this stuff happens, maintenance, tenant attrition, all sorts of things. So the smaller your mortgage balance, if you've got 4 properties and you're saving £80 each property by taking a low interest rate, then that could stop you from putting money into the deal. So yeah, there's various options. And as always, the all-in rate's really important. So the all-in rate essentially is the 5.5% because you blend your arrangement fee through into your interest rate.
A question I get asked a lot is, should you roll that arrangement fee into your product and make it like a monthly payment, or just pay it upfront in one go? When you run the numbers for the clients, what's normally the best option?
So when we recommend, I'll provide a master rate sheet with 5-year fixes, 2-year fixes, and arrange within each banding. Low interest rate versus high interest rate, and then the all-important all-in cost at the end with your pounds and pence that you pay back as well. So I'll take a mid-range product. On this sheet, I would have the all-in rate maybe 5.86%. But option 1 would be 4.86% on a 5-year fix with a 5% fee. So that 5.86 is with your 5 years worth of monthly arrangement fees. So that's what you're really paying.
Yes.
The all-in rate. So that all-in rate allows to compare different products against a pound for pounds comparison.
I love that.
So it's really interesting because some people might say, oh, it's 4.86, brilliant. Well, it's not. It's 4.86 plus your 5% fee that you added onto your loan. Okay. So it's really important to understand what you're really paying. And that's definitely what investors want to see at the moment. Because the market is becoming more professional and clients must behave like investors, not landlords.
Absolutely.
Rates are important. You've got to know what you're spending and how. So that you might say, well, I don't need to concentrate on low monthly payments and take a product fee. I want to pull that product fee down. So you can pull it down, but you'd be sacrificing your interest rates.
Yeah.
So your monthly payments will be going up, but your total overall costs will be going down. So that's why it gets really layered. That's why the type of property that you're buying really matters. Because if you're buying a new build flat with service charges and lots of monthly dependencies on your cash flow, you're going to want low interest rate, higher fee because you want to preserve your cash flow.
Sure.
But if you're buying a new build house with no service charge, nothing else, you might go, I don't need to do that. I'm happy to sacrifice my interest rate, have a slightly higher monthly payment, but overall I'm winning because I'm focusing on capital growth. And I want to preserve my equity by having a low balance because no fees been added to it, because you're just simply focusing on long-term growth and you're not really watching your cash flow. So it really does get detailed and it really does depend on the property. But there's so many options. This is why I'm really keen to speak to all the clients. And I think all brokers should do that. I think that clients, if they're getting recommendations via email and not talking through things like that we're talking through now, I think a lot of clients may miss a trick. So yeah, just pin down your broker and try and talk through all those options.
This is why I love doing these regular updates about mortgages on the podcast, because it's so much more than the headline rate. But that's when most people will stop. They'll see a headline rate and that's it. That's their due diligence done. Oh, that's roughly what I'm going to pay. But as you've just highlighted, there's so much more to it. How's sentiment with lenders right now? So sentiment in the property market generally, I would describe people feeling flat about UK property. The numbers are actually better than the sentiment, which is strange. But I would describe sentiment as fairly flat. I wouldn't describe anyone as enthusiastic right now. How are lenders? How are they approaching this market? What would you describe their sentiment as right now?
The banks is a cautious approach, but still with competitive rates. Again, it's one arm of a financial organisation, so they can afford to be slightly more optimistic and bullish with interest rates.
Yeah.
I think with the specialist lenders, which operate, in the limited company space, I think they need to be positive because it's their business.
Yeah.
But I think the challenge they face is the volatility of the interest rates. So this is why you see changeable interest rates. So if you get an offer today and your offer's valid for 3 months, your rate might change 2 or 3 times because the SONIA swap rates are volatile, because of the global economic factors that we've been navigating through. Lenders, when they can be, they will be really positive because they want the business. But at the same time, if those SONIA swap rates increase, they simply have to raise their interest rates. So cautious approach, but they will be bullish when they can do because they simply have to.
And how about products? Are we seeing roughly a similar amount of products as a year ago, more, less? What's happening with the market at the moment?
A similar number. Obviously, we were quite early into 2025 and we're just recovering out the pullback from October's events. So it's the same amount of products. I don't think the amount of products is a limitation. It's just getting your timing right because, like you say, one particular lender that's used quite a bit in the limited company space, in September, they were 4.99%. At the end of the year, they're 5.7%.
Wow.
Yeah. So there's, especially in a limited company space, there's lots of things at play, not just funding lines, but there's internal capacity issues at lenders. A lot of these lenders are quite small operations. So if they're overwhelmed with business, because their rate was 4.99, they're going to get busy. Their SLAs are going to increase, sometimes up to 7-10 days. So they're going to increase their rate, stop the inflow of business to manage their pipeline. So you've got that to battle with, along with just business sentiment. Another lender in the market who was always really competitive took the viewpoint last year that they would concentrate on adverse mortgages and not buy to let. So we're navigating through that. It's a business choice to lend, and it just depends on the overall organisation and what their priorities are. But essentially, lenders want to be bullish. They have capacity issues, and the rates will be as low as they can when the funding lines are low. This is why an ongoing relationship with a broker is good, because I will tell my clients when the rates are good and we'll try and hold back when they're not so good.
Makes sense. Let's carry on that theme of sentiment, because a year ago, valuers or surveyors, I would say sentiment was, well, rock bottom. Everything, it seemed, was getting downvalued. No matter what you were buying, just everything would get downvalued. It felt that way anyway.
Yeah.
It was absolutely crazy. And, you know, we do stuff with like really strong deals, and then even they were getting downvalued. They were just marking everything down no matter what you bought it for. At least that's what it felt like. Did you feel like that? And if so, how is it today? How has it changed? Are we still playing that same game? It doesn't feel as bad to me, but you're a lot closer to it.
Well, I think surveyors are probably full of fear last year, kind of. Maybe the companies remember in 2008 where they were providing bullish values and not able to recall the security with the appropriate level. If you speak to a surveyor, they will literally say what they see. And at the moment, I don't think you get many surveyors projecting or saying, yeah, great area, fantastic opportunity, etc. It's cold, okay? So they will look at comparable evidence in the area, full stop. So if you're a property or in an area of regeneration, at the start of that phase, you might struggle because there's nothing else around it, no matter the quality of the property. But if you're a house in a city centre, big residential developer, you probably got more chance of getting your valuation. But I don't think valuers are taking any chances, essentially, especially if they work for a larger firm like Connells or someone like that. They might have a directive which is led down from the top to give a certain approach, which is, the rich qualified surveyors, that's what they have to do, right? So we have to kind of respect that, even though it can be frustrating. But it always circles back to being an investor, not a landlord, and having a more investor approach. If you're going into deal maybe just with that 25% and then you're paying to start the deal, it's going to be really disappointing for you. If you get a down valuation, you need to find an couple of thousand here or there to pay for this additional deposit. So I think being aware of that and preparing yourself for it is great. I'm sure a lot of people will probably want 75% lending for obvious reasons, especially for a certain age, maximising, your leverage. But I think 70% should be in your mind as an investor, but obviously go for 75. But just protecting yourself, there's so many different elements to this market where it gets quite frustrating for me and clients because, it's not cheap for clients. It's you're paying into a long-term deal, and capital appreciation is, you can't see or feel it until it's happened.
I want to pick up on something you said because I've long held this view. So it's quite interesting. kind of touched on it a little bit, and you said that a directive from the top.
Yeah.
And it did feel with these surveyors that suddenly all these wild down valuations that they were being instructed or guided possibly to be very conservative with their valuations. I know we don't have any solid proof there, but it sounds like you had a similar feeling.
Yeah, I mean, you do wonder, just like with any piece of information you receive on your desk, you're like, how, what, when, why? You know, it's the obvious questions. So the surveyor will always, well, for starters to say it's not going to change their mind.
No. If you are listening, I think that's let's just stop on that point for a moment. If you are working with someone and you get a down valuation, don't waste your time. I don't think in all the years, and there's many of them now, I don't think I've seen a down valuation overturned. You do with more mortgages, but me personally, I've not seen one. And I used to argue way back when I felt we had super robust evidence to overcome it. But even with that super robust evidence, like a property on the same floor, the same template, a higher valuation, and then ignoring it. I've seen all of that. So now I just don't even bother guiding anybody to contest against the down valuation.
Yes, it's going back to that more pragmatic approach with surveyors. They're simply not going to change their minds. I think it's important to remember that when you receive a valuation, not a down valuation, I always get told off for saying that, it's a valuation, okay? So there's three important elements or three different channels that you can work through. So simply proceed, okay? More cash in, take the deal. Potentially property at the moment is equity heavy exercise anyway. So if you're down to 65, 70, 71, 72%, is it the end of the world? Probably not. With the ultimate respect to everyone's bank balance and earnings, of course. The second thing to walk through is, to reapply to a different lender with a different surveyor.
Yeah.
I think clients are keen on that. I'm not so keen on that because unless I've seen the evidence of it coming back elsewhere, because I don't want clients, throwing around £500 willy-nilly trying to get it. And the third one is, like you just mentioned, contest.
Yeah.
So get some really solid comparable evidence, send it to the lender, ultimately to the surveyor, and see what they say. Are people going to want to put some more money into the deal? Probably the most likely scenario. Are we going to reapply, get a better valuation elsewhere? I don't think that's something that we should flippantly jump into.
No, but you do see it. And I think that's where a lot of the frustration comes from, because I'll see a lot of valuations on a single development sometimes. And you'll see some value just fine. And then there'll be a certain surveyor individual who doesn't like the site and downvalues it. And that's where it really bothers me, because that's when it becomes a human subjective thing. One human likes it and one human doesn't. And that's where it feels almost unfair. It's because you're then at the mercy of, that person could be having a bad day. They'll never admit that, but we have good days and bad days. And if that person's having a bad day, the weather might have been bad, they've not liked that site, they've not taken to it, maybe not taken to the person who showed them around. I'm not saying these are all things that definitely result in a down valuation, but you can see how it could become part of the mix, especially when another surveyor will walk in and go, oh, well, I see it worth £20,000 more than that person.
Yeah, and this goes back down to, if I see that evidence, then we obviously will do the reapplication, and it doesn't have to be a client with me elsewhere on another site. Speak to the agent, our valuations come out positively elsewhere, if so, who with? So it's all about your due diligence, really, and your ongoing relationship with your agent and your broker, because the strength you have in that relationship, the more information you can get to make the relevant decisions. But the valuation process is frustrating, because as much as I said at the start of the conversation, it's objective. They say what they see. Sometimes you feel it's overly subjective, and you're like, well, I can see the evidence. So it is an interesting one, to say the least.
But is it, I know down valuation still happen today, but it seems like it's better than it was a year ago.
Yeah, I'd say it's better. I mean, sentiment is there, isn't it? I think people are feeling more positive. Maybe people and professionals are just used to the way it is.
Yeah.
They're not seeing any dramas unfolding in the future, Trump aside, and tariffs aside. So, yes, I think maybe everyone's just used to where we are now, perhaps.
But this is the great thing about talking about this and making it normal for people, because if you're an investor and you're not buying multiple properties a year and you've just made your one investment and then you've got a down valuation, and maybe it's only the second or even your first property you've ever invested in, it kind of feels like a big deal to you. You see it from the big picture. You see that, sentiment's poor, the conservative, might not be realistic, but they're being conservative. And to you, it's unemotional. But how do you deal with a client who feels quite emotional about that decision and then starts to question their own investment?
Like with any challenge in any client relationship, it's just about giving the client as much information as possible. Especially me, I'm always sympathetic to these scenarios because, I don't look after clients' money, but I think of it as my own almost. I don't like all the fees that clients pay, for example.
Yeah.
Re-inspection fees, re-offer fees, it's a lot. So if you compound that with a down valuation, it's a lot to take in. I think there's a lot thrown at customers in the market at the moment. It's a very viable and buoyant market, but there's a lot to deal with. So I just deal with that by just giving as much information as possible, having an ongoing relationship. It just goes back to the fundamentals of not being a transactional advisor and just having that ongoing relationship, and hopefully maybe clients half expecting it.
Yeah, and you'd hope that the clients have done their research and then they still have confidence in their number, because if they've done the research, which every single person should do if they're buying a property, and they've established that, yeah, I believe this is the value. If the surveyor down values it, well, that's someone who has a different point of view to you. But for me, I don't think you're necessarily losing out, because the valuation may be different, but if you believe in it, that's fine. Yeah. But also, when people hear, oh, I've got to put more money in, you're not losing that money. No. That's just equity. And I think that's a common mistake people make, is that certainly when I've spoken to people that, oh, I've got to put another £5,000 in, this has cost me another 5,000. It has cost because it's cash you've had to put in, but you've not lost it. You've just put it into equity. And I think that's something that not all investors, but some investors do miss.
I completely agree. My preference is to be slightly more equity heavy. So that kind of falls in line with what we're saying. It's really difficult because, it's clients' money at the end of the day. But I think vanilla buy-to-let, standard AST buy-to-let is probably frustratingly slow for people. It's capital growth, 5 years, 10 years, 15 years. Is your cash flow going to be there at the start? At the moment, it's probably going to be quite tight, but obviously your cash flow hopefully gets better throughout the years because maybe you're not over leveraging and your rent's increasing.
Yeah.
It's just having that long-term view. And again, circling back to being a professional investor, you've got different categories of investor, and maybe teething problems like this is something that everyone will experience in all different asset classes. It's just realizing what works for you and what doesn't work for you. I think with vanilla buy-to-let, I think that we're all keen on cash flow. Of course, it has to work, but especially for expats, it's not a focus because currency plays into your favour. But if you just remember long-term and being equity heavy, I don't think that's a bad thing at all. And like you say, it's just the education at the start and being comfortable with your approach.
Definitely. And working with someone experienced like yourself or whoever they work with, who's been there, seen it, done it, and isn't emotional about it, and trying to get clients to that point of no emotion, which is hard, right? Because we're all human, but it is, particularly if you're new to investment. If you take a long-term view, like you've said, these are just little bumps in the road and barely a bump. When you look back after 10 years, it was like, what was I even bothered about? But I can understand the here and now, and when people are going through it, it can be a little bit of an emotional roller coaster when the mortgage market is, as you say, much better than it was, but still a little bit bumpy.
Well, it's just maybe like a UK economy and cost of living question as well. It's not the easiest environment at the moment. Obviously, everything seems to be getting more expensive. Mortgage rates are going up. To live costs a lot. So when you get a situation like this, it almost feels like the world's against you and you're just spending, which makes investment choices difficult, and it needs to be more thorough with your due diligence at the start, really. So don't put everything you have into a single buy-to-let. You want to maybe diversify a little bit more. But I think in the UK market, definitely it is difficult out there. So when you're being asked to put more into a deal, after we were all working really hard for our money and paying fees, mortgage rates going up, childcare, et cetera, it probably does feel like, when does it stop? Yeah. So I'm really respectful to that because it's, we're all going through it. It is really important, which goes back to working with the right people, which goes back to having a conversation at the start, and being really open and honest with your scenarios. Like, I know we've talked about this before, that I don't really recommend 2-year fixes.
Yeah.
That kind of ethos is dying off slightly. I'm reconsidering it slightly because of a couple of products I've seen in the last couple of months. But I think that 2-year products are expensive. You've got big product fees. Your cost of refinancing is quite a lot. You've got valuation challenging. You've got all the professional service fees, brokers, valuers, lenders. So if you're doing that every 2 years to get equity, I think the risks are quite significant. So if clients do go with the 2-year fix, I'd like clients to understand the product risk, the valuation risk and the cost risk. That's obviously turning away business for 5 years, which is I'm more than fine with, because it can get really expensive really quickly. So it's about making that right decision and not trying to rush through appreciation as well. I think that is probably the sole common understandable mistake that clients fall into, is trying to recycle equity too often.
Yeah. So things are still tricky. Let's look forward. Let's hope your medium-term horizon is more upbeat. But you tell me if it isn't. Mine always is, but I'm a bit weird like that. It's always good things ahead.
Positive.
But the interest rates are coming down. Rents are improving for investors. If sentiment catches up with what is actually taking place, which the fundamentals are actually improving, then it could be an interesting, I don't think anything's going to dramatically change, but it could be an interesting 12 months. And then 2 years on from where it was dire to hopefully a better position than where we are today. But that's my view. And I don't want to put words in your mouth. So what's your view? How do you see the next 12 months going for the mortgage market?
Yeah, I think in summary, without me kind of running off in different directions, I think the market is positive. I think a 5-year fix for 5 years, limited company, 4.5% is a good rate for an equity capital appreciation focused asset.
And you think we'll get there this year? Or
no, absolutely. I said 4.5% at the end of last year, and we got there momentarily. Before they went up again. So I think we'll get there. But, being a bit of a bore and circling back to being an investor, not a landlord, your property choice directly impacts your lender choice.
Oh, massively.
So, low interest rate environments mask poor investment choices for us all. Okay. Yeah. So going back to performing your due diligence and everyone taking it quite seriously, making sure you've got a property that can achieve these mortgage rates. If you do that well, I think, you're going to get your growth and you're going to be a success. But it's just all about being thorough and getting the right partnership around you.
Great. And Nick, I'd be crazy if I didn't ask this, because we're actually recording this together in Dubai, which is very nice.
Yeah.
But expats and their mortgage market, what does that look like for them? So if you're an expat, you want to invest in the UK, what options are available?
More than you think. The banks and the building societies offer the cheapest rates. Obviously, like we mentioned, same in the UK world, where the UK guys will start at 4.5%, expats might start at 5.5%, at the end of the year, 5.9% now, and they're with no fees.
Okay.
I think with expats, obviously, you've got the currency playing in favour, especially if you're in the UAE. So you're probably not so focused on product fees, etc. But it's the same principles. Your property choice would directly impact your lender choice. The swing with expat rates can get quite dramatic. Like I say, if you start at 5.5%, 5.9%, this is limited company.
Sure.
You could end at 6.99% if you're in a location that is of a certain category for lenders, or you're buying 7-bed HMO. So again, it's about performing your DD, but rates can be fairly decent for expats. I don't think that's anything to be worried about, but it's the same principles really. Property choice, lender choice, performing your due diligence and just, hoping that you can get to the left-hand side of that range and get the 5.9% with the flat fees. But the expats have plenty of options, especially UAE-based, Hong Kong-based, China, here and there. So there's plenty of options.
Brilliant. Nick, thank you for coming on, sharing all your knowledge. It's been a pleasure.
Thank you very much.
Just before we wrap up this week's show, time for Hub Extra, that part of the show where we try to bring you a little bit more. And this week, a tool from producer Dan, which I'm really excited about checking out, because I'm pretty good at getting to the gym. What I'm not good at is stretching and flexibility. I know it's important, but I just can't bring myself to do it. But Dan has surfaced an app called Pliability. You can find it at pliability.com. And the cool thing is, as well as guiding you through a whole load of mobility workouts, it also starts with an assessment. So it can use the camera on your phone while it puts you through some drills to identify what's holding you back, where your restrictions are, and build you a program tailored to that, which I think is just great, because I know when I try and watch a YouTube video, I cannot do half the things that they're doing, but I don't know what specifically I should work on first to get the best results. So you can get a 7-day trial and start with that assessment, which is definitely what I'm going to be doing as soon as we've wrapped up this week's episode. That is us done for this week. Hope you found this episode useful. I'm sure you did. I'll be back next week. Hopefully Rob B will be as well. So until then, have a great week. See you soon. Bye-bye.